Hello and welcome to my note. Today I'd like to talk about perverse and perhaps counterintuitive beneficiaries of rising bond yields, and they are corporate pension plans. If you're a corporate pension manager, you are as worried about future liabilities as you are about your assets, and those liabilities are critically dependent on bond yields. Let's illustrate that with this chart, which shows you UK pension assets and liabilities since 2006. When you're measuring liabilities, those are in the future and you need a discount rate at which to discount them. The lower the discount rate, which is ultimately set by bond yields, the higher those liabilities will be. So you can see, looking at this chart, that British companies entered the crisis in surplus, just about, with assets a bit higher than liabilities. And you can see that the really big problem for them is not so much that their assets were falling with the market crash, but their liabilities have been going up. And also, again, very counterintuitively, the worst period for them wasn't the period of the Lehman crash, 08 and 09, but 2011 and 2012, when bond yields really dropped very, very drastically, while stock prices were broadly horizontal. Now, there's a corollary to this. This obviously puts companies into a very serious problem. Somebody has to meet those promises that have been made to their workers. There is a corollary that if bond yields begin to rise, to the consternation of many others, that does significantly ease the difficulty for corporate pension funds. Let's illustrate that with this chart that comes from Mercer for the S&P 1500, a broad index of US companies. You can see again, they reached Lehman just about in surplus, and then very quickly went into a very severe deficit. At one point, their funded status, i.e. the proportion that liabilities made up of their assets, was almost down to only 2/3. And you can see that over the last year or so, there has been a really very dramatic improvement in that funded status. The shortfall has gone from more than 30% to only just over 10%. That's in part because stocks have been doing well, but it's primarily because of the sharp rise that we've seen in Treasury bond yields over that period. Now, investors in the stock market have also been paying attention to this. In the years before the crisis, those companies that had a particularly big pension deficit began to trade at a discount because investors recognized that there was an extra risk there. In the case of Goldman Sachs, they have produced an index of the 50 European companies in the Stocks 600, which have the highest pension liabilities as a proportion of their market cap. And what we're showing you here in this chart is how those stocks, that index, has done compared to the rest of the stocks index, and mapping that against the change in German Bund yields. And you can see that the correlation is very close and that the outperformance is very dramatic. As bond yields have increased, so people have rushed to buy the stocks of those companies that had the worst deficits, those companies that will benefit most from rising bond yields. Now the question has to arise, however, has this been overdone? Naturally, we now know that the market was a little ahead of itself in terms of how quickly the Fed was going to move. Also, you need to bear in mind that while the read-through from bond yields is very direct in the States, in the UK, they also have to worry about index linking, and real yields, and the yields on index-linked bonds tend to be more important. And in the case of Europe, you also need to look at corporate bond yields, which have not moved as fast as government bond yields. I think, therefore, that there is some evidence that this rally in the stocks of the companies with the worst pension deficits has probably been overdone so far. But there are important messages for the future. First of all, do keep an eye on those stocks which do have bad deficits. Once bond yields start rising again, yes, they should benefit. And perhaps most importantly, given all the concern about rising bond yields that is out there, there are important beneficiaries to rising bond yields. With higher bond yields, with a more normal bond market, it becomes much easier for companies to meet their promises to their pensioners.